You hear people talking about the stock market every single day. The news reports whether it went up or down. Your coworkers mention their portfolios during lunch. You see headlines about million-dollar gains and devastating crashes. And yet, if someone asked you right now to explain what the stock market actually is and how it really works, you'd probably struggle to give a clear answer. You know it has something to do with buying and selling stocks, and you know some people get rich from it, while others lose everything. But the actual mechanics of how it all fits together feel like a mystery. That mystery is costing you money every single day you don't understand it. Because the stock market is one of the most powerful wealth-building tools in human history, and it's accessible to anyone with a smartphone and a few dollars to invest. Today I'm going to pull back the curtain and show you exactly what the stock market is, how it works, and why it matters to your financial future. Even if you've never invested a penny in your life, let's start with the absolute basics, and I mean the most fundamental level possible. The stock market is essentially a place where people buy and sell ownership stakes in companies. That's it. That's the core of what it is. Now, when I say place, I don't necessarily mean a physical location anymore. Though there are still physical exchanges like the New York Stock Exchange with its famous trading floor. These days, most trading happens electronically through computers and smartphones, but the concept remains the same. It's a marketplace, just like a farmer's market where people buy and sell vegetables. Except instead of vegetables, they're trading pieces of companies. So let's dig into what it means to own a piece of a company. When a company wants to raise money to grow their business, build new factories, hire more people, or expand into new markets, they have a few options. They could take out a loan from a bank, but that means they'd have to pay interest and eventually pay the money back. Or they could sell ownership stakes in the company to investors. These ownership stakes are called shares or stocks. Let's use a simple example to make this crystal clear. Imagine you and 3 friends start a pizza restaurant together. You each put in $10,000, so the total investment is $40,000, and you each own 25% of the business. That's your share. Now imagine your pizza restaurant becomes incredibly successful, and you want to open 5 more locations, but you need $200,000 to do it. You could go to investors and say, hey, we'll sell portions of our ownership in exchange for cash. Maybe you sell 40% of the company for $200,000. You and your original partners each own 15% instead of 25%, but you have the money you need to expand. The people who bought that 40% now own shares in your pizza company. This same basic concept applies to the stock market, just on a much bigger scale with much bigger companies. When a company decides to sell ownership stakes to the public for the first time, it's called an initial public offering, or IPO. This is when a private company becomes a public company. Before the IPO, only the founders, early employees, and maybe some private investors own shares. After the IPO, anyone can buy shares and become a part owner. Companies like Apple, Amazon, Google, and Tesla all went public at some point in their history, which allowed regular people to buy ownership stakes in these businesses. Now, once a company goes public and their shares are available to buy, those shares need somewhere to be traded, and that's where stock exchanges come in. The most famous exchanges in the United States are the New York Stock Exchange, which is often shown in movies with people shouting and waving papers on a trading floor, and the NASDAQ, which is completely electronic. These exchanges are the marketplaces where buyers and sellers come together. If you want to buy 100 shares of Apple stock, you place an order through a brokerage, which is like a middleman that connects you to the exchange. Your order goes to the exchange. And if someone is willing to sell their Apple shares at the price you're offering, the trade happens. It's that simple in concept, though obviously there's sophisticated technology making it all happen in milliseconds. Here's where it gets interesting, and where the stock market really becomes dynamic. The price of a stock isn't fixed by the company. It's determined by supply and demand, just like anything else in a marketplace. If lots of people want to buy Apple stock and not many people want to sell, the price goes up. If lots of people want to sell and not many want to buy, the price goes down. These price movements happen constantly throughout every trading day, which is why you see stock prices changing in real time. The price reflects what people collectively believe the company is worth at any given moment, based on all available information about the company's performance, future prospects, the economy, and thousands of other factors. Let me give you a real-world example to show how this works. Let's say a pharmaceutical company announces they've developed a breakthrough drug that cures a common disease. Investors hear this news and think, wow, this company's about to make billions of dollars selling this drug. Suddenly, tons of people want to buy shares in this company because they believe it's about to become way more valuable. All these buy orders flood the market, and since demand is high and supply is limited, the stock price shoots up. Maybe it goes from $50 per share to $80 per share in a single day. That's how news and information move stock prices. On the flip side, imagine that same company gets sued for making false claims about their drug. Investors panic and start selling their shares because they're worried about lawsuits and damage to the company's reputation. Now everyone's trying to sell and nobody wants to buy, so the price crashes down to $30 per share. This constant push and pull of buyers and sellers based on new information is what makes the stock market move. Now, you might be wondering, why do people buy stocks in the first place? What's the point of owning a piece of a company? There are two main ways people make money from stocks. The first is through price appreciation, which is a fancy term for the stock price going up. If you buy a share for $50 and later sell it for $80, you've made $30 in profit. That's called a capital gain. The second way is through dividends, which are payments that some companies make to their shareholders. Think of dividends as the company sharing its profits with the owners. If you own 100 shares of a company and they pay a dividend of $1 per share per year, you get $100 annually just for holding the stock. Not all companies pay dividends, especially younger, fast-growing companies that prefer to reinvest their profits back into the business. But many established companies like Coca-Cola or Johnson & Johnson have been paying dividends for decades. Let me explain what determines whether a stock is a good investment or not, because this is where a lot of beginners get confused. A company being successful and a stock being a good investment are related but not exactly the same thing. You might have an amazing company that makes great products and earns tons of profit. But if everyone already knows how great it is and the stock price is really high, you might not make much money buying it now. The key is whether the current price accurately reflects the company's value or not. If a stock is trading at $10 per share, but you believe the company is actually worth $20 per share based on its earnings growth potential and other factors, then that might be a good investment because you think the market will eventually realize the company is undervalued and the price will rise. This is why investing isn't just about finding good companies. It's about finding good companies at good prices. The stock market as a whole tends to go up over long periods of time, even though it goes through cycles of ups and downs along the way. Since the stock market launched in the United States in the late 1700s, it has grown tremendously over the centuries despite wars, depressions, recessions, pandemics, and every crisis you can imagine. The reason is pretty logical when you think about it. Companies exist to make profits, innovate, and grow. The economy as a whole tends to expand over time as populations grow, technology advances, and productivity increases. So when you invest in the stock market broadly, you're essentially betting that human innovation and economic progress will continue, which is a bet that has paid off historically. This doesn't mean the market can't crash or go through terrible periods. It absolutely can and does. But over spans of decades, the trend has been upward. Let me address something that scares a lot of people about the stock market: volatility. Volatility just means that prices move up and down, sometimes dramatically. You might invest $1,000 today and tomorrow it's worth $900. That's scary, especially when it's your hard-earned money on the line. But here's what you need to understand. The stock market is volatile in the short term, but relatively stable in the long term. If you look at the market's performance over any single year, it could be up 30% or down 20%. But if you look at rolling 10-year periods throughout history, the market has been positive the vast majority of the time. This is why financial advisors always stress that investing is for long-term goals. If you need money in 6 months, the stock market is not the place for it because it could easily be down when you need to sell. But if you're investing money you won't need for 10 or 20 years, short-term volatility becomes mostly irrelevant because you have time for the overall upward trend to work in your favor. There are different ways to invest in the stock market, and understanding these options is important for beginners. The first option is buying individual stocks, which means picking specific companies to invest in. You might buy shares of Microsoft, Disney, and Ford if you believe those particular companies will do well. The advantage is that if you pick winners, you can potentially earn really high returns. The disadvantage is that picking winners is incredibly hard, and if you choose poorly, you could lose most of your investment. Professional investors and hedge funds struggle to consistently pick stocks that beat the market, so as a beginner, trying to beat the pros at their own game is tough. The second and more popular option for beginners is buying index funds or ETFs. Instead of picking individual companies, index funds let you buy a little piece of hundreds or thousands of companies all at once. An S&P 500 index fund, for example, holds the 500 largest publicly traded companies in America. When you buy one share of this fund, you instantly own tiny pieces of Apple, Microsoft, Amazon, and 497 other major companies. This gives you instant diversification, which means you're spreading your risk across many companies instead of putting all your eggs in one basket. If one company in the fund goes bankrupt, it barely affects your overall investment because it's just 1 out of 500. This approach is much safer and is what most experts recommend for regular investors. The stock market also includes different types of stocks beyond just the well-known big companies. There are large cap stocks, which are the biggest companies with market values in the hundreds of billions of dollars. There are mid-cap and small-cap stocks, which are smaller companies that might have more growth potential, but also more risk. There are growth stocks, which are companies expected to grow rapidly, and value stocks, which are companies that seem underpriced relative to their actual worth. There are dividend stocks that pay regular income, and there are international stocks from companies based in other countries. As a beginner, you don't need to worry too much about all these categories. Just know they exist, and that different types of stocks serve different purposes in a portfolio. One of the most important things to understand about the stock market is that it's forward-looking. Stock prices don't reflect what a company did last year. They reflect what investors believe the company will do in the future. This is why sometimes you'll see a company report record profits, but their stock price actually drops. Maybe investors expected even higher profits. Or maybe they're worried about future challenges. The market is always trying to price in future expectations, which is why it reacts so strongly to news and why it can seem irrational in the short term. There's also an emotional and psychological component to the stock market that's really important to grasp. Markets are driven by human beings making decisions based on information, but also based on fear and greed. When times are good and stocks are rising, people get excited and want to buy more, which pushes prices higher. This can create bubbles where prices get way too high relative to what companies are actually worth. Eventually, something triggers a correction. People panic and sell, and prices crash. Then when prices are low and everyone is pessimistic, that's often actually the best time to buy, but it feels the scariest. Understanding this psychological cycle can help you avoid making emotional decisions that hurt your returns. The mechanics of actually buying and selling stocks today are incredibly simple. You download an app like Fidelity, Robinhood, or Charles Schwab, open an account in about 10 minutes, link your bank account, transfer in some money, and you can start buying stocks or funds immediately. The technology has made it so accessible that anyone with a smartphone can start investing. But just because it's easy to execute trades doesn't mean it's easy to invest successfully. That requires understanding, patience, discipline, and a long-term perspective. Let me also touch on something called market indices, because you hear about these all the time on the news. An index is basically a measurement tool that tracks how a group of stocks is performing. The Dow Jones Industrial Average tracks 30 large American companies. The S&P 500 tracks 500 large companies. The NASDAQ tracks technology-focused companies. When the news says the market was up today, they're usually referring to one of these indices going up, which means the average price of the stocks in that group increased. These indices give us a snapshot of how the overall market or specific sectors are performing. Something else that impacts the stock market is the broader economy and actions by governments and central banks. When the Federal Reserve raises interest rates, it affects stock prices. When there's economic growth, corporate profits tend to rise, which is good for stocks. When there's a recession, profits fall, and stocks usually decline. Government policies, international trade, inflation, unemployment, and countless other economic factors all play into stock prices. You don't need to be an economist to invest, but understanding that stocks don't exist in a vacuum and are influenced by these bigger forces helps you keep perspective when markets get crazy. Before I wrap up, I want to emphasize something crucial. Everything I've shared in this video is for educational purposes only and not financial advice. I'm not a licensed financial advisor, and your personal situation is unique. You should do your own research and consider consulting with professionals before making investment decisions. My goal is to help you understand what the stock market is and how it works, not to tell you specifically what to do with your money. So here's the big picture. The stock market is a marketplace where ownership stakes in companies are bought and sold. Prices move based on supply and demand, driven by information and emotions. Over long periods, the market has trended upward as the economy grows. You can invest by picking individual stocks or by buying index funds that give you broad diversification. It's accessible to anyone with an internet connection, but successful investing requires knowledge, patience, and a long-term perspective. The stock market isn't some mysterious entity that only rich people can access. It's a tool available to everyone, and understanding it is the first step toward using it to build wealth for your future. If this video helped demystify the stock market for you and you feel like you actually understand it now, I'd really appreciate it if you hit the like button. And if you want to keep learning about investing, personal finance, and building wealth in a way that's actually clear and practical, go ahead and subscribe to the channel. In the next video, we're going to talk about how to actually start investing in the stock market step by step. Even if you're a complete beginner, thanks so much for watching, and I'll see you in the next one.